Imagine a situation where the United States does not have to repay $9 trillion of debt in one single day, but still faces a massive financial problem because that debt has to be refinanced at much higher interest rates. That is the story the bond market is watching right now, and it could become an important story for gold and silver. According to the source, around $9 trillion of U.S. government debt is scheduled to mature during 2026. That sounds like an enormous number, but the rollover itself is not necessarily the crisis. The real question is what interest rate the Treasury has to pay when that debt is refinanced. And this is where the story becomes much more interesting for precious metals. The United States has been operating with a much higher cost of borrowing than it had several years ago. The source points out that bond yields have risen from roughly 1% in 2020 to around 4.6%, largely because of higher inflation and, to a lesser extent, concerns about government debt. That change may look small when expressed as a percentage, but when you apply it to trillions of dollars of government borrowing, the impact becomes enormous. And here is the open question: what happens if Treasury yields continue rising while the government needs to refinance huge amounts of existing debt? This is not simply a Treasury market problem. It can eventually become a dollar problem, an inflation problem, a monetary policy problem, and potentially a gold and silver problem. The source argues that the Treasury has been looking toward shorter-term borrowing rather than relying heavily on new 30-year debt, partly because long-term Treasury yields influence other borrowing costs, including mortgage rates. The source puts U.S. mortgage rates around 6.7% and connects elevated borrowing costs with weakness in the housing market. For gold investors, this creates an important contradiction. Normally, higher interest rates can be negative for gold because gold does not pay interest. Investors can instead earn a yield from bonds. But there is another side to the equation. If higher yields are being driven by concerns about inflation, fiscal deficits, debt sustainability, or declining confidence in government finances, then the same bond market pressure can strengthen the long-term argument for holding hard assets. And that is exactly why this $9 trillion rollover deserves attention. The key question is not whether America can roll over its debt. The source itself makes clear that existing holders, money market investors, and the Federal Reserve can potentially continue buying the maturing debt. The bigger issue is that refinancing is becoming increasingly expensive, so the market may eventually face a difficult choice. Either Treasury yields remain high enough to attract buyers, which increases the government's interest burden, or policymakers attempt to keep borrowing costs under control, which could increase pressure on the Federal Reserve and the financial system. And if that second path eventually involves easier monetary policy, renewed Treasury purchases, or additional liquidity, the implications for gold and silver could become much more significant. That is where this story moves beyond a headline about $9 trillion. It becomes a question about whether the world's largest economy can refinance an enormous debt load without creating another inflationary or monetary shock. Now, this is where the $9 trillion debt rollover becomes much more serious. The United States does not simply have to refinance a huge amount of debt. It has to refinance that debt in an environment where the cost of borrowing has already risen dramatically. The source gives us an important comparison. In 2020, the U.S. government was paying around $521 billion in interest payments. This year, that figure has reached approximately $1.184 trillion. And based on the projection discussed in the source, annual interest payments could rise above $2.1 trillion by 2036. Think about what that means. The government is increasingly spending money simply servicing debt that already exists. According to the source, interest payments currently account for about 14% of federal spending, and that share could rise to roughly 19% within a decade under the stated assumptions. This is the part that matters for the bond market. If Treasury yields remain elevated, every new refinancing cycle can gradually push the government's average borrowing cost higher. The debt does not need to default for the problem to become significant. The problem can develop slowly through the budget itself, and this creates a difficult feedback loop. Higher inflation can push bond yields higher. Higher yields increase the cost of refinancing government debt. Higher interest expenses increase fiscal pressure. Greater fiscal pressure can make investors demand even more compensation to hold long-term government bonds. That is the cycle investors need to watch. For gold, this creates a very different setup from the traditional argument that higher yields are bad for gold. Yes, higher real yields can create competition for gold. But if yields are rising because investors are demanding compensation for inflation and fiscal risk, the interpretation becomes more complicated. The bond yield itself is no longer the entire story. The reason behind the yield increase becomes critical, and there is another important development in the source. The Treasury is reportedly favoring shorter-term financing in an effort to avoid putting too much upward pressure on long-term yields. That strategy can buy time, but it does not eliminate the underlying debt. Short-term borrowing has to be refinanced more frequently, so if interest rates remain high, the government becomes increasingly exposed to the prevailing market rate. This is why the $9 trillion figure can be misleading if we look at it in isolation. The real story is not America needs $9 trillion in cash immediately. The real story is America needs to continuously refinance a huge debt stock while the price of money is much higher than it was several years ago. And now we reach that could become particularly important for precious metals. The source argues that inflation remains a major risk for the bond market, with higher energy prices and geopolitical tensions adding pressure. It also describes the Federal Reserve as having ended quantitative tightening and beginning to purchase Treasury bills under what it calls reserve management. The source notes that some observers view this as resembling a form of QE. If monetary policy eventually becomes more accommodative while fiscal deficits remain large, the market could face a difficult combination: enormous government borrowing needs alongside pressure to keep financial conditions from becoming too restrictive. That is precisely the environment where gold can become more than simply an inflation hedge. It can become a hedge against monetary uncertainty. Silver adds another layer because it combines monetary characteristics with industrial demand. If the macro environment produces stronger demand for precious metals while industrial activity remains resilient, silver can potentially respond differently from gold. But there is a major risk here. If Treasury yields surge too quickly, the dollar strengthens, and real yields rise sharply, precious metals could experience significant short-term pressure. So this is not a straight-line bullish argument. The important signal is what happens next to inflation, Treasury yields, Federal Reserve policy, and the dollar simultaneously. Because if the government increasingly needs lower borrowing costs while inflation refuses to disappear, policymakers may eventually face a choice that the gold market has been watching for years. And that choice brings us directly to the Federal Reserve, because the next question is whether the Fed can keep inflation under control while the Treasury desperately needs affordable financing. Now we get to the most important part of the debt story, the Federal Reserve. Because the United States can refinance its debt, but refinancing becomes much more difficult when borrowing costs remain high. And if inflation is still above target at the same time, the Fed cannot simply cut rates aggressively without risking another inflation problem. That creates a potential policy trap. On one side, the economy and the Treasury want lower borrowing costs. On the other side, persistent inflation requires monetary policy to remain restrictive enough to prevent prices from accelerating again. The source makes this tension particularly clear when it discusses the Federal Reserve's return to Treasury market purchases. According to the source, quantitative tightening has ended while the Fed has started buying Treasury bills under the description of reserve management. Some observers interpret this as resembling quantitative easing because the central bank is increasing reserves while purchasing government debt. For the gold market, this distinction matters. Markets do not only react to what policymakers call a program, they react to what the policy actually does to liquidity and financial conditions. If the Fed is adding liquidity while the Treasury is simultaneously managing an enormous refinancing requirement, investors may begin asking whether monetary policy is becoming increasingly connected to fiscal needs. That does not automatically mean the United States is monetizing its debt. The source itself does not establish that conclusion, but it does highlight a growing tension between controlling inflation and maintaining manageable financing conditions. And this is where gold becomes extremely interesting. Gold does not depend on the solvency of one government. It does not require a coupon payment. It is not somebody else's liability. So when investors become concerned about the long-term purchasing power of currencies or the credibility of monetary policy, gold can become a form of insurance. But there is an important distinction between the short term and the long term. In the short term, rising Treasury yields can still pressure gold. If investors can earn significantly more from government bonds, the opportunity cost of holding a non-yielding asset increases. But in the longer term, the question becomes, why are yields rising? If yields are rising because economic growth is strong and inflation is under control, that can be a difficult environment for gold. If yields are rising because investors are demanding compensation for persistent inflation, fiscal deterioration, and growing government debt, the signal becomes much more complicated. And silver could potentially amplify that move. Silver has both monetary and industrial characteristics. So that means it can respond to monetary uncertainty while also being influenced by economic activity and industrial demand. So if investors move toward precious metals, while the industrial economy remains reasonably resilient, silver can potentially outperform gold during certain phases of the cycle. But there is another pressure building in the background: the dollar. The source describes concerns about foreign demand for U.S. treasuries and highlights changes in the behavior of major holders. It specifically points to China gradually replacing some treasury exposure with gold purchases. That does not mean foreign investors are abandoning the dollar overnight. The source actually notes that China still has an interest in maintaining a strong U.S. economy because of its export relationship with America, but even a gradual diversification matters. If central banks and large investors increasingly want assets outside the traditional treasury dollar system, gold can benefit from that structural demand. And this is why I would not reduce this entire story to one headline saying $9 trillion is coming due. The deeper story is about confidence. Confidence in treasury demand, confidence in fiscal discipline, confidence in inflation control, and ultimately confidence in the purchasing power of the dollar. If those forms of confidence remain strong, the debt can continue to be managed. But if confidence starts weakening while inflation remains sticky and borrowing costs stay elevated, the market could begin pricing a very different future. And that brings us to the next question. What happens if the debt problem collides with a slowing U.S. economy and a weakening labor market? Because that is where the debt story could become significantly more volatile for both gold and silver. Now we have to connect the debt problem with the other side of the U.S. economy, growth. Because high debt is much easier to manage when an economy is growing strongly. Tax revenues are rising, companies are expanding, employment is healthy, and investors are more willing to absorb government borrowing. The problem begins when debt is rising at the same time that economic momentum is weakening. The source points to evidence of a slowing U.S. labor market, including weaker employment growth and a decline in labor force participation. At the same time, consumer confidence has been under pressure because of squeezed wages and weaker purchasing power. That creates a difficult combination. Imagine an economy where government debt continues climbing, interest costs are increasing, but economic growth is losing momentum. The government may need to borrow even more if tax revenues weaken. And if a recession eventually arrives, the deficit can expand further because revenues decline while government support programs increase. The source estimates that a recession could increase the deficit by another roughly 20% to 33%. Now, ironically, a recession could also provide one relief mechanism. If economic activity collapses, inflationary pressure would likely weaken. That could allow interest rates to fall and reduce pressure on treasury yields. And this creates another contradiction for gold. A recession can push yields lower, which can support gold. But a recession can also strengthen the dollar because investors often seek liquidity and safety during periods of financial stress. So gold's reaction would depend heavily on what policymakers do and how markets interpret that response. If the Fed cuts rates because inflation is falling naturally, gold could benefit from lower real yields. But if policymakers are forced to provide liquidity while inflation remains stubborn, the market could interpret that as a much more significant monetary signal, and that is where the long-term debt problem becomes important. The source cites a projection that U.S. debt could eventually approach approximately 175% of GDP without major changes to taxes and spending. It also highlights demographic pressure from an aging population, which increases spending on pensions and healthcare while reducing the size of the workforce supporting the tax base. This is not a problem that can be solved simply by refinancing 1 year's maturities. It is a structural issue, and structural problems are exactly what precious metal investors need to watch, because gold does not require the government to fix the problem. Gold simply responds to the consequences of the problem. If debt continues increasing faster than the economy, if interest expenses consume a larger share of the budget, and if inflation remains difficult to control, the market eventually has to reassess the value of money and government debt. That is potentially bullish for gold. Silver could respond even more violently because its market is smaller and its demand comes from both investment and industry. But there is a critical warning here. We should not assume that a large U.S. debt burden automatically means gold and silver will rise every day. Markets do not work that way. There can be long periods where the dollar strengthens, treasury yields rise, and precious metals correct, even while the underlying fiscal situation continues deteriorating. The source itself provides a more balanced picture. It notes that the U.S. has major advantages, including its own currency, a large economy, and deep financial markets. It also emphasizes that government debt does not automatically translate into default because the United States controls its own currency. So the thesis is not an imminent U.S. default. The more interesting thesis is purchasing power. A government with a very large debt burden has a strong incentive to avoid a disorderly rise in borrowing costs. If inflation remains above target, however, efforts to suppress yields can create another problem: the risk that investors begin demanding an even greater inflation premium. And once that psychology becomes established, gold can become increasingly important. This is why I believe the next major signal is not simply the $9 trillion maturity figure. Watch the interaction between Treasury yields, inflation expectations, Federal Reserve liquidity, the dollar, and economic growth. If yields rise while growth weakens, that is one signal. If yields fall because the Fed becomes more accommodative while inflation remains elevated, that is another. And if the dollar begins losing confidence at the same time that central banks continue accumulating gold, the precious metals story becomes considerably stronger. So the final question is no longer whether the US can refinance its debt. It can. The real question is, what price will America have to pay to keep refinancing it? And what happens to gold and silver if that price keeps rising? That is where it gets interesting, because we can now build the bullish, bearish, and most likely scenarios for precious metals. So where does all of this leave gold and silver? The most important point is that the $9 trillion rollover itself is not a reason to expect an immediate crisis. The debt can be refinanced, and the source explicitly argues that existing holders, money market investors, and the Federal Reserve can continue to participate in treasury markets. The real problem is the rising cost of carrying that debt, and that gives us three possible paths. The first is the relatively bullish scenario for the US economy. Growth remains strong enough to support tax revenues, inflation gradually moves lower, treasury yields stabilize, and investors continue demanding U.S. government debt. In that environment, the debt burden remains large, but the market does not see an immediate threat to financial stability. For gold, that could mean periods of consolidation or even sharp corrections, particularly if real yields remain attractive and the dollar stays strong. Silver could be even more volatile because it has a significant industrial component. A stronger economy can support industrial demand, but higher rates and a stronger dollar can still create pressure on precious metals. The second scenario is more complicated. Economic growth slows significantly, but inflation remains sticky. The Federal Reserve then faces the exact conflict we have been discussing. The economy wants lower rates, while inflation argues for caution. That would be a very different environment. If the Fed begins easing while inflation remains uncomfortable, Treasury yields may not necessarily collapse. Instead, investors could demand an additional premium for holding long-duration government debt. That is where gold becomes particularly interesting. Gold can potentially benefit from falling policy rates while simultaneously acting as protection against persistent inflation and monetary uncertainty. Silver could follow, but with much greater volatility. Then there is the third scenario, the one that could create the strongest long-term precious metals thesis. Debt continues rising, interest payments consume an increasingly large share of government spending, economic growth weakens, and policymakers increasingly rely on liquidity and easier financial conditions to stabilize the system. The source already highlights how dramatically the interest burden has increased, from approximately $521 billion in 2020 to $1.184 trillion currently, with projections above $2.1 trillion by 2036. If that trajectory continues, the market may eventually start thinking less about whether the United States can pay its debt and more about how the debt will be managed without damaging the purchasing power of the currency. That is a completely different question. And historically, when investors become concerned about the purchasing power of fiat currencies, gold becomes increasingly important as a monetary asset. There is another structural signal worth watching: central bank diversification. The source notes that China has been gradually replacing some U.S. Treasury exposure with gold purchases. It also points to uncertainty around the traditional recycling of foreign reserves into U.S. Treasuries. That does not mean the dollar is about to lose reserve currency status. It means the margin of safety may be changing, and that is precisely why I would watch gold not simply as a trade, but as a signal of confidence in the global monetary system. For silver, the story becomes even more asymmetric. If monetary uncertainty increases and investment demand rises, while industrial demand remains healthy, silver has the potential to react more aggressively than gold. But if the economy enters a severe recession, its industrial exposure could also create additional downside pressure. So my base case is not a prediction of an overnight debt crisis. It is a prediction of increasing volatility around the relationship between debt, inflation, yields, and monetary policy. The $9 trillion maturity figure is the headline. The interest bill is the deeper problem. The Fed's policy dilemma is the potential trigger. And gold and silver are the assets that could increasingly reflect the market's confidence, or lack of confidence, in how this entire system is being managed. The source itself makes an important point. The United States has enormous economic advantages and can create money to service dollar-denominated obligations. So talking about an imminent sovereign default would be misleading. But avoiding default is not the same thing as avoiding inflation, currency depreciation, or financial repression. That distinction is critical. So over the coming months, I would watch 5 things very closely: 10-year Treasury yields, inflation expectations, Federal Reserve liquidity, the US dollar, and central bank gold demand. If those 5 indicators begin moving in the same same direction, the precious metals market could be sending a much bigger signal than the debt headlines alone suggest. And that is the real story behind the $9 trillion. America does not necessarily have a debt rollover crisis. It has a cost of debt problem. And if the cost keeps rising while growth slows and inflation refuses to disappear, the pressure on policymakers will increase. For gold, that could create a powerful long-term tailwind. For silver, it could create something even more explosive, but also much more volatile. This is not a guarantee that either metal goes straight higher. Markets can surprise both bulls and bears. But if the debt burden keeps climbing, interest costs keep accelerating, and monetary policy becomes increasingly constrained, one question will become impossible for investors to ignore. How much is the dollar really worth when the system needs more and more liquidity just to keep the debt machine moving? That is the question I will be watching. And as always, this is analysis, not financial advice. Do your own research before making any investment decision.